In this video, I want to share with you how to get funded in 4 simple steps. Hi traders, welcome back to the channel. If you're new here, my name's Liam and I'm a mathematics and finance graduate turned trader. And I've been trading, investing and coaching within the financial markets for the last 8 years. And honestly, when I first started trading, I blew so many funding accounts. And I've just learned so many different strategies, tools and techniques around prop firm challenges that can really help you get funded faster. And so that's why in this video, I really want to share with you everything that I've learned along the way. So with that being said, let's dive into it. Okay, so this is how to get funded in 4 simple steps. So step number 1 is often the most important, yet it is often the most overlooked. And step number 1 is develop a robust trading strategy. And so I remember when I first started trading 8 years ago, I remember I was in a university lecture and I remember putting on this gold position and within 5 minutes, this position was up £5,000. And then what ended up happening was we went on a night out and then I woke up the next day and this trade was minus £10,000. And the problem here was that I didn't know why I was entering. I didn't have a clear invalidation and I didn't know when to exit the position. And so what I was really doing was basing a trade based on discretion rather than basing my trade on a robust trading strategy. And so robustness, this simply means that your trading strategy is backed up by real quantitative data and results, and that your strategy is proven over historic data. And so this also links to trading a rules-based mechanical trading system, because you should know every single trade when you're turning up to the markets, why am I entering this position? Where is my invalidation going to be? And where am I going to be looking at taking profits in the market? And so what you really need to develop is a trading plan in the market. So essentially this is your game plan and this is your blueprint. So this is what you're going to be following every single day when you turn up to the market. You're not looking at chasing any other strategy. You're just looking at trading your game plan. And so with me coming from a mathematics and finance background, something that I found very, very helpful was thinking about your strategy in terms of parameters. So basically, if you're implementing something into your strategy, that element or that aspect that you're implementing, that needs to be fully defined. It needs to be fully mechanical. And if you can't make that element or that parameter into a black and white framework, then for me, that parameter is not reliable, because this also links to your back testing data. Because if all of the rules are defined in your trading system, then that is going to lead to more reliable backtesting data. Because again, this links back to the story that I've just told you. If you're entering a position based off discretion, then it is extremely likely that your backtesting data is not reliable and therefore your system is not robust in the markets. And so I really want you to think about how can you fix your parameters in your trading system, and are the parameters constant every single trade? If they're not, it's very likely that your trading strategy is not reliable, and it's very likely that you do not have a significant edge in the markets. And that is why this is the most important aspect to passing prop firm challenges, because without a trading system, without a profitable edge in the market, it's extremely unlikely that you will not be consistent trading prop firms over the long term. And remember, the reason why we're trading is because we have a long-term vision. For me, I like to backtest my repeatable trading systems over hundreds and hundreds of trades, and often over years and years of data. This is to ensure that your data is very reliable in the market, and so this helps further increase the robustness of your trading system. This point was amazing, but if you don't understand this next point, it's extremely unlikely that you will succeed over the long term with prop firms in this space. And step number 2 is choosing a reputable prop firm. So 4 years ago, I bought a funding challenge. I traded my system and I passed the prop firm challenge. I requested a payout and I was expecting a $7,000 payout. 2 days later, my payout was rejected, and 5 days later, the prop firm shut down. And what I thought was I could save money by choosing a cheaper prop firm in the market. And what ended up happening was I was sacrificing prop firm credibility, because I was choosing a prop firm that was maybe not as credible as some of the bigger prop firms in this space. And so with that often comes worse customer service, and this lack of reputation decreases the probability and decreases the chances of you actually getting paid out. out. So for me, the most credible prop firm in this space is FTMO. I've used them for the longest, and they've never rejected any payouts for myself. Literally the other week, I requested a payout, and it was in my bank within 3 hours. Yes, you're maybe going to be paying a little bit more for a funding challenge, but in my eyes, it's worth every single penny. Because with this comes credibility, with this comes the likelihood of actually being paid out, and with this comes better customer service. And so if you remember that our goal here is to have a longer term time horizon, and so in order to increase our longevity in this space, it's extremely important that we pick a reputable prop firm in this space. If you're looking at picking up a prop firm challenge, I have a link in the description down below to FTMO. Most traders don't think about step number 3, but to be honest, I think it's one of the most important. And this is to decide on your risk profile. And so what this comes down to is really a few things. Number 1 is, do you know the maximum amount of drawdown that you've ever seen in historic data for your trading system? So based on my data and my strategy, the maximum drawdown that I've ever seen is around 7%. And this would be if you're using 1% risk every single trade. And so what we can then do is bake this into the prop firm rules. Because for most prop firms, the maximum drawdown that you're allowed on one single account is 10%. And so what that means to me is if we're using 1% risk, it's extremely unlikely that we're ever going to blow a funding account because the maximum drawdown that we've ever seen is 7%. But we know that the maximum that we're allowed is actually 10%. But then for me, this is where it gets more interesting. And what your risk profile really means is what are you willing to risk on every single trade? So for one, this needs to be uniform. And all that simply means is that you're going to be risking the same amount on every single trade. It doesn't matter how you're feeling. It doesn't matter what your previous trade was like. It doesn't matter if you're on a losing streak. And so it's extremely important that you risk the same amount every single trade. And this is what I found a lot of success with. And so what I like to do with challenge phases with prop firm capital is I like to risk 2% on every single trade because I don't want to be sat there for months and months trying to pass a funding challenge. And I understand that yes, there's going to be some times when I'm going to blow a funding challenge. And as long as you can accept this risk, and as long as you're okay with this, then you're okay to use 2% risk in the markets. If you're not okay with this and you wouldn't be okay with blowing a funding challenge, then I would recommend to stick to 1% risk. And what this 2% allows us to do is it allows us to be more aggressive in the markets. And it also allows us to get funded faster. And so no, I'm not saying go crazy and risk, say, 5% on a trade. We're still being very, very smart here. We're still using uniform risk management and we're still calculating position sizes on every single trade. But then once we are past the challenge phase, what I like to do is then drop it down to 1%. And this is really just to ensure the longevity of my prop firm trading account and just to reduce the probability of me actually blowing this funding account. You know, at the end of the day, I'm not going to tell you what you should be risking on every single trade, but this is what I like to do and this is what has personally worked for me. But it really depends on your risk appetite, it depends on your risk profile, and it really comes down to how much you're willing to risk and put into your prop firm progress. Of course, this is not financial advice, this is just something that has worked for me, and so I just want to share with you my experience. Step number 3 was incredible, but if you don't understand step number 4, there is no way that you will ever become profitable. And step number 4 is managing your funded accounts. When I first found out about prop firms, I thought, you know, this is amazing. What I'm going to do is I'm going to have $1 million. I'm going to stack all of my funding accounts into one portfolio, and I'm going to trade it all as if it was one big fund. And what I realized is you're exposing yourself to way too much risk in the market. All it takes is an extremely bad period in time with your trading system. You could then blow all of the challenges and you're then back to square one. And so for me, I've never really liked the idea of trading all of my capital in one huge fund, and I'm more a fan of trading it in terms of a balanced, diversified portfolio. And all that simply means is I'm not trading all of my capital in one go. I may be trading 2 or 3 funding accounts at a time, and so I'm diversifying my risk. I may be allowing myself to be a little bit more conservative in the market. And so what I recommend is to diversify your prop firm capital. I recommend not copy trading all of your accounts in one go. And I also recommend having backup prop firm accounts. So let's say something happened where you did actually blow an account, and this could be something that was maybe down to human error, and this could be due to like maybe accidentally trading into NFP or CPI, and this just means that you always have an account, and so that you can always put risk on the table, because remember, time that you're trading the challenge phase in your account, this is time when you could actually be making money in the market. But also something that is also very, very important is dealing with drawdowns on your prop firm accounts. And so it's going to look something like this. Let's say that this y-axis is equity. Let's say that the x-axis is time. So what you're going to see with a profitable system is you're going to see your equity curve go up. You're going to have a pullback in the equity curve. You're going to have a higher high, pullback, higher high, etc. And so these up periods right here, these represent outperformance of your trading system, and these down periods right here represent pullbacks in your equity curve. And so this really links to how we can manage prop firm accounts, and this really links to how we can scale prop firm challenges. So let's say that we're in a 8% or 7% drawdown, and that is represented by this pullback in your equity curve right here. And so just think about it logically, right? Like, when is the best time to actually buy a funding challenge? Is it during periods of outperformance like at this high right here? Or is it during periods of underperformance like this time right here? And so that should be very, very obvious. It's when your system or strategy is underperforming. And how do we know if it's actually underperforming? Let's say that we plotted a line of best fit on your equity curve. Well, if we're below the average and we're below the line of best fit, then your system will be underperforming. And so for me in my system, this is when we're in around a 5 to 7% drawdown, because as we've discussed, this is around the maximum drawdown that we've ever seen based on historic data. And so the expectation when we are around these drawdown times is that we actually come out of this drawdown. And so we expect higher prices in our equity curve. And so what ends up happening, let's say that you buy a challenge during this drawdown phase. When you come out of drawdown, this original challenge will be passed, and the other challenge that you're already trading, this will then be coming out of drawdown as well. So what you're going to do is you're going to take one account out of drawdown, and you're going to actually pass a challenge on the second account. And this is a advanced prop firm scaling technique that I've personally used. I've used it multiple times this year in order to pass and gain extra funding capital. And I really think it's one of the most effective ways to scale prop firm capital. So it's really about reverse engineering your mind. Traders get into the trap of buying more challenges when you're on a very, very hot period. But for me, the best time is to buy when we're actually in a significant drawdown. That is the time to be more aggressive in the markets. However, this doesn't really mean much unless you understand a actual profitable mechanical system. And so what I'm going to do is leave a link to that video on screen right now. Check it out if you want to learn a profitable proven system. And as always, thanks so much for your time and support. Take care, guys. Bye-bye.